In 2024, a 1967 Ferrari 275 GTB sold at auction for $4.1 million. That same year, the S&P 500 returned roughly 23%. The Ferrari returned over 400% in 10 years. Wall Street built a 100-year industry around the idea that stocks are the smart money. Cars are transportation. Cars depreciate. Cars are a cost, not an asset. That was the story they told you. A garage in Newport Beach, California, 2019. 3 men, a hedge fund manager, a retired aerospace engineer, and a former car dealer, put $4 million into vintage automobiles instead of the market. By 2025, that collection was worth $11 million. In the last decade, the top tier of the classic car market has outperformed the Dow Jones by a factor of 2. Not in one freak year. Consistently, over a decade. That is not an accident. That is a market shift. And almost nobody is talking about it yet. Hey, this is Mark, and you're welcome to AUTOSAYS. If that number already changed the way you're looking at the car in your driveway, stay with me. Hit subscribe so you don't miss where this goes. Because what I'm about to show you goes a lot deeper than a few rich guys spending money on pretty cars. But before I get into the numbers, I need to tell you about something that happened in Scottsdale, Arizona, in January 2026, at the Barrett-Jackson auction. Because what sold there and what didn't tells you everything about where this market is actually headed. And I'll come back to that story in a few minutes, because it changes the whole picture. Let's start with what everyone gets wrong about vintage cars as investments. Most people assume this is a hobby for billionaires, a vanity purchase. You buy a Porsche 911 from 1973 because it makes you feel something, not because it makes you money. That assumption was mostly right until about 15 years ago. Then something changed. In the years after the 2008 financial crisis, a specific kind of buyer entered the classic car market. They weren't car people, not primarily. They were capital allocators, people who managed large pools of money professionally. And they noticed something the car world had overlooked for decades. Physical, tangible, emotionally resonant assets were holding value through economic downturns in a way that financial instruments were not. Gold had always been the traditional hedge. Real estate, of course. But a 1969 Chevrolet Camaro Z28, in original, unrestored condition, had something gold, and real estate didn't. It had cultural gravity. It had a story. It had scarcity that only got more extreme with every passing year. There are only so many of these cars in the world, and the number goes down, not up. Every year, some are destroyed in accidents. Some are stripped for parts. Some just rot in fields. The supply is permanently shrinking. That is the iron law behind everything you're about to hear. Now here's where it gets strange. The cars that are rising fastest aren't necessarily the most expensive. They're not the Ferraris and Aston Martins that make the headlines. The biggest percentage gains in the last 5 years have come from a specific category. Cars produced between 1960 and 1985 in original or near original condition, from manufacturers with strong brand loyalty. Japanese cars from the late 70s and early 80s. American muscle from the mid-60s. European sports cars that never got the attention of the trophy hunter crowd. A first-generation Toyota Corolla GT from 1983. The AE86, the Hachi-Roku, was selling for $5,000 to $8,000 a decade ago. Today, a clean, original example commands $40,000 to $60,000. That is a 700% return. Not a typo. 700%. And the reason for that specific Cars Rise tells you the entire story in miniature. The AE86 generation grew up. The kids who idolized that car in the 90s, through Initial D, through grassroots racing culture, through drift competitions, are now in their 30s and 40s. They have disposable income for the first time. They have nostalgia for the first time. And they are going into the market looking for exactly that car. Demand spiked, supply didn't move, price went vertical. This is a pattern that repeats across every generation of collector cars. It happens on roughly a 30-year cycle. The cars that were cool when you were 17 become the cars everyone wants when you're 45. The market is not random. It is predictable if you know where to look. Now let me come back to Scottsdale. At the Barrett-Jackson auction in January 2026, something unusual happened. A 1971 Plymouth Hemi Cuda convertible, one of the rarest American muscle cars ever, built with documented provenance, was expected to sell for over $4 million. It sold for 2.8, below estimate. And in the same auction, 3 cars from the late 70s and early 80s, none of them famous names, none of them celebrity owned, sold above estimate. One of them, a 1981 DeLorean in unrestored condition, doubled its estimate. That tells you exactly where the money is moving. The ultra-premium segment, the cars that were always treated as trophies, is softening. The financial buyers who drove that market up between 2010 and 2020 are rotating out. They found their entry, they found their exit, they moved on. But the emotionally driven collector segment, the people buying the cars of their youth, that segment is just getting started. This raises a question that almost no financial analyst is asking yet. If vintage cars are outperforming equities, on a risk-adjusted basis, and for a specific category they are, why are they still treated as a hobby rather than an asset class? The answer is liquidity. You can sell a stock in 3 seconds. Selling a car takes weeks, sometimes months. You need storage, insurance, maintenance. The transaction costs are real. And the market is fragmented. There's no centralized exchange, no real-time price transparency, but here's what's changing. Platforms like Bring a Trailer and Cars and Bids have created something that didn't exist 10 years ago. A transparent, public, searchable price record for virtually every collectible car on the market. For the first time, buyers and sellers have real data, and when buyers have real data, serious money follows. The institutionalization of the vintage car market is happening right now. Several alternative asset funds have launched in the last 3 years, specifically focused on collector vehicles. Fractional ownership platforms are letting regular investors buy a share of a classic car the same way they'd buy a share of a REIT. The barriers that kept this market fragmented are coming down, one by one. And when institutional money fully enters a market, any market, prices do one thing. They go up. If you own a financially interesting car today, original condition, documented history, the right model from the right era, you may be sitting on an asset that has more upside in the next 10 years than your brokerage account. That's not a prediction. That's a pattern that is repeated in slightly different form every decade since the first collector car auctions began in the 1970s. The people who understood this early, who saw what was happening before the financial press caught up. They didn't buy the most famous cars. They bought the right cars, the overlooked cars, the ones with a generation of buyers who hadn't yet arrived at the age where nostalgia turns into spending, and some of those cars are still affordable today. For now, here is the real takeaway. The stock market is a bet on the future, on earnings, on growth, on things that haven't happened yet. A vintage car is a bet on memory, on what already happened, and on how much that memory is worth to the generation that lived it. The market for the past, it turns out, is more predictable than the market for the future. Here's the question I want to leave you with, and I'd genuinely like to know your answer in the comments. If you had $50,000 to put into either the S&P 500 or a single collector car right now, which would you choose? And which specific car? Because that answer says a lot about where this market is heading next. If this changed the way you think about cars or money, hit like and subscribe. Because the next video is going to make you look at an entirely different asset class, in a way you've never considered before. One that's hiding in plain sight, and that the auto industry has been quietly profiting from for 50 years, while everyone else looked the other way.